We will now continue our discussion on bonds payable, and this time the discussion will focus on still on the computation of the subsequent carrying amount of the bonds payable, but this time using the effective interest method. So basically, under the effective interest method, the amortization to the discount or premium class would simply be the difference between the computed interest expense and the interest payment based on the stated rate. If you compare those two, the difference would be the amount of amortization, the amount of adjustment to the discount or premium related to the bond. From the first year of the bond down to its last year, the discount or premium will slowly go down so that by the end of the term of the bond, the carrying amount of the bond will now be equal to its face value. And by then, the recognition of the payment would simply be a debit to your liability and a credit to your cash. So our goal here is to determine the subsequent carrying amount of the bond using the effective interest method. Okay, and one of the most common question here would always be to compute for the interest expense. And again, if you're asked to compute for the interest expense and the method used is the effective interest method, all you have to do is to multiply the previous carrying amount with the effective interest rate, which would sometimes be given as the yield rate. And once you multiply the yield rate or the effective interest rate, the product would immediately be your interest expense for the year. Okay. Another commonly asked question here would be, of course, the carrying amount for the subsequent periods. How much is the carrying amount of the bond at the end of the first year? How much is the carrying amount of the bond at the end of the second year? So on and so forth. And in relation to that, another possible question that is commonly asked would be, how much is the remaining discount or premium on the bond? Again, as mentioned, a bond will be issued either at a premium or a discount. If the price is greater than the face value, then the bond is considered to be issued at a premium. If the price is lesser than the face value or the face amount, then the bond will be considered as being issued at a discount. Now, again, that discount or premium will slowly go down so that by the end of the term of the bond, it will become zero. Okay, so it is understandable why problems will be asking how much is the balance of the premium, how much is the balance of the uh, discount after year one, after year two, so on and so forth. Okay, and if you'll be able to compute for the remaining premium or discount, if you will be able to compute for the unamortized premium or discount, that could actually help you solve for the carrying amount of the bond, because the carrying amount of the bond would simply be the face value minus the discount or plus the premium. Again, it is simply the face value or the face amount minus the remaining or unamortized discount or plus the remaining or unamortized premium. So uh, those two questions, the remaining or the unamortized premium or discount, and the carrying amount of the bond are actually related. Okay, so you can use the unamortized premium or discount to solve for the carrying amount, or you can simply prepare the amortization schedule so that you will be able to arrive at the carrying amount of the bond. Okay, so that's why the by maturity of the bond, its carrying amount will be equal to its face value because the remaining premium or discount will now be zero. Okay. Again, those three uh, would be the questions that will be asked in relation to this topic. Uh, that is the computation of the accounting for bonds payable subsequent to its initial recognition. Okay. So we have here problem 6-14. We'll start with problem 6-14 since the illustration involves annual amortization. Once we've discussed annual amortization, we'll go back to problem 6-11 and 13. 12 and 13, wherein the amortization happens more than once a year. Okay. So the first question here is, what amount should be reported as discount on bonds payable? So basically, question number one here is asking you how much is the remaining discount on the bonds payable? How much is the unamortized discount on bonds payable as of December 31, 2022? Now, this is asked because the problem starts on January 1, 2022. Okay? This is the date in which the bonds were issued. After the lapse of some time, after a lapse of some period, the expectation there is that the premium or discount will not be the same, because again they are supposed to be amortized. Okay, so for us to determine how much is the discount on the bonds payable as of December 31, 2022, we must determine first how much then was the initial or the starting balance of our discount. Okay, and it would be very easy for us to determine this problem, especially that it is explicitly stated. Okay. Uh, On January 1, 2022, Ward Company issued 9% bonds payable with face amount of 4 million, which mature on January 1, 2032. The bonds were issued for 3,756,000 to yield 10%. The 10% here will be our effective interest rate, okay, resulting in bond discount of 244. Okay, so this would be our initial or our starting balance for our discount. Okay, and if you look at the choices for number one, all of those choices are lesser than 244,000, because again it is expected that if our discount started at 244,000, its balance after 1 year uh, uh, will not be 244,000. It will actually be lesser than 244,000. Now, before going any further in this problem, I think it's important for us to understand what's happening. Why is there a discount, or why is there a premium? Think of it this way. You issued the bond for 3,756,000. That means the amount of money that you got in exchange for the bond that you issued is only 3,756. By the time it matures in 2032, how much are you going to pay? You will not just be paying the amount that you receive, you will actually be paying 4 million. So by January 1, 2032, you will have to pay the holder of the bond in the amount of 4 million. That is after all the interest that you have paid from 2022 to 2032. Okay. So all in all, you have basically two kinds of obligation here. Number one, obligation to pay interest, and number two, obligation to pay the principal or the face value upon maturity. The interest is paid periodically, meaning it is not just paid one time. It is not just paid in 2032. In this case, every year. Okay, as stated here, interest is payable annually on December 31. Every year, you will pay interest on December 31. Now, it is understandable why we have to pay interest, because we are using the money of some other person. Okay, and at the end of the year, at the end of the term of the bond, we will also have to pay the 4 million, because we will have to return the principal. Okay, so definitely the amount of interest that you will be paying periodically will be part of your interest expense. But the problem is, if the bond is issued at a discount, it's actually as if you are paying more than what you have received. Okay, you only receive 3,756,000, but you will be paying. Okay, uh, aside from the interest, you will be paying the principal 4 million, even though the actual amount you have received is only 3,756,000. Okay, so if we're going to be very strict with it, if you received only 3,756,000, then that should be the amount that you will have to pay at the end. Okay, but because you issue the bond at a discount, you acknowledge that it's difficult for you to get 4 million. You settled at 3,756,000. Okay, and you are paying 4 million at the end of the term of the bond. It actually tells us that you're paying extra. Aside from the interest, you are paying an extra 244,000. Where did we get the 244,000? The difference between the face value and the amount that you receive. Again, your obligation at the end will be 4 million, but you only actually receive 3,756,000. So it actually means you're paying an extra 244,000. Okay. Now, you can treat this 244,000 as a loss, but the problem is the standard does not allow us to recognize the entire loss, to recognize the entire 244,000 in a single period, because the 244,000 loss here is actually related to the bond, and the bond is in this problem is good for 10 years. So the standard dictates, the rules require us to spread out or to amortize the 244,000 over the periods in which the bond will be outstanding. Because since the loss is related to this transaction, then it should be spread out over the period in which the transaction uh, is outstanding. Okay, so the 244,000 here is actually a loss on our part because we only received 3,756,000, and we will have to pay 4 million at the end of the term of the bond. Okay, but the rule does not allow us to recognize the entire loss immediately. The rule requires us to spread out or amortize the amount of loss, or in this case, it is referred as a discount. We are required to spread out the discount over the term of the bond. So, in accounting, this loss is basically viewed as an additional interest expense on your part, because essentially anything you pay in extra of what you have received is treated or considered as an interest. You only receive 3,756,000, but you will have to pay 4 million. Anything you pay in excess of what you have received will be treated as an interest. So, aside as from the fixed interest payment that you will have to make, there's actually additional interest expense as far as accounting is concerned by virtue of the discount or the loss related to the issuance of the bond. Okay. So every year you will have to pay a fixed interest computed by multiplying the stated rate of 9% with the face value of 4 million. That will give you 360,000. So every year you will have to pay 360,000. Okay. Now, the 360,000 will be recognized as an interest expense. But if you will be asked how much is the total interest expense for the year, it will not just be 360,000. Why? Because we have to gradually recognize as interest expense the loss or the discount that we have incurred as a result of the issuance of the bond. So the interest expense year in, year out will not just be the fixed 360,000 that we will be paying, but it will include the amortization of the discount. Okay, so there are different ways in amortizing the discount. What we are discussing today is to amortize the discount using the effective interest method. Okay, so whatever is the amortization class, then that would be your additional interest expense. Whatever is the amortization and the discount, that is the additional or extra interest expense that will be recognized. But the good thing with the effective interest method is that we do not have to start our computation with a fixed interest. Okay, the formula or the computation is actually very simple and straightforward, which we will demonstrate later on. But I hope you understand the concept behind the discount. Okay, you're paying more than what you have received, so the extra money you will be paying aside from the agreed interest will be considered as interest as well. But such amount will not be allowed uh, to be recognized immediately as an expense. It will have to be spread out or amortized over the term of the bond. Now, on the other side class, what if it is issued at a premium? What does that mean? You are getting more from you're getting more than the value of the bond. Okay, I think that's actually the scenario in problem 6-15. In problem 6-15, the face value is 5 million, but you received 5,675,000. Okay, you received 5,675,000, but how much will you be paying at upon the maturity of the bond? Only 5 million. So you can actually say you have a gain of 675,000. You have saved 675,000 because you received 5,675,000, but you will only be returning 5 million. Okay, so you can actually look at the premium as a gain, but again, you are not allowed to immediately recognize the gain uh, upon the issuance of the bond. The gain will also have to be you will also have to be amortized over the term of the bond. Okay, now the premium will be treated as sort of a savings. So this would be offset against the interest that you will be paying on the bond. So the amortization on the premium will actually be a reduction. The amortization of the premium will actually be a reduction to your interest expense. The amortization of your gain will be offset against the interest expense that arises from the bond. Okay, if it was a discount, the amortization of the discount will serve as an additional interest expense, while the amortization of a premium will be a reduction to your interest expense. Okay, we'll demonstrate this as we solve the problems. So going back to problem 6-14, the question here is how much would be reported as discount on the bonds payable. Again, to solve for this one, we will have to find our starting or initial bond discount and determine the amount of amortization. And as mentioned earlier, the amortization and the discount would simply be the difference between the fixed interest payment, the agreed fixed interest payment, minus the interest expense. Now, the question is how much then is the interest expense? Under the effective interest method class, the computation of your interest expense would be very straightforward. Okay, you will simply have to multiply the carrying amount, the previous carrying amount of the bond, with the effective interest rate, or in this case, the yield rate. So the initial carrying amount of the bond is the 3,756,000 given in the problem. You multiply it with a yield of 10%, which is our effective interest rate, then you would get 375,600. That is the interest expense. So if in this problem you will be asked how much is the interest expense for 2022, your answer would be 375,600. And how did you get that one? You simply multiply 3,786,000 with 10%. Now you compare that one with the agreed fixed interest payment. How much interest will be paid every December 31? Again, it is simply be based on the stated rate or the nominal rate with the face amount. The face amount here is 4 million. You multiply it with 9%. So the agreed interest payment is 360,000. But again, your interest expense is 375,600. So that means there is an extra aside from the 360,000 you are paying, there's an extra how much? What's the difference between 375,600 and 360,000? You will have an extra of uh, 15,600. So that is the additional interest expense. Okay, aside from the fixed 360,000, where is that coming from? That is the amortization on the discount. Okay, that's the amount of discount that will be recognized as an expense in the first year as a result of the amortization of the discount. So if you will be asked how much is the amortization of the discount for year one, your answer would be 15,600. So if we started with 244,000 and we have already amortized 15,600, meaning we have already transferred 15,600 to your expenses, how much then is the balance? Okay, so you simply deduct the 15,600 from the 244,000 and you will have 228,400. Okay, so the 228,400 there is simply your initial discount of 244 minus the amortization and the discount amounting to 15,600, which is the difference between the fixed interest payment and the interest expense for the year. Now, what is the carrying amount of the bonds payable? What is the carrying amount of the bonds payable? Again, the carrying amount is simply the face value minus the remaining or the unamortized discount or premium, or plus the premium. In this case, we only have a discount. Okay, so we start at 4 million and deduct the balance of your discount after 1 year. How much is the balance of the discount? It is 228,400. So you deduct the 228,400, you deduct it from 4 million. The carrying amount of the bond would be 3,771,600. So if you notice, it actually increased from the previous year. The initial carrying amount was 3,756. It is now 3,771,600. So just like your bond discount slowly decreasing towards zero, your carrying amount would also slowly uh, increase towards its face amount if it's a discount. If it's at a premium, it will slowly decrease towards the face value. Okay, just remember that the carrying amount is simply the face value minus the discount or plus the premium. Okay, so four possible questions can be asked in this kind of problem. Number one, how much is your interest expense? The answer is 375,600. Number two, how much is the amortization of the discount for the first year? That would be 15,600. Number three, how much is the discount on the bonds payable? How much is the unamortized discount on the bonds payable? It would be 228,400. And last question would be how much would be the carrying amount after 1 year? And the answer is 3,771,600. And those four questions could be asked also for 2023, for 2024, so on and so forth. Okay, let's try problem 6-15. On January 1, 2022, Wolf Company issued 10% bonds payable with face amount of 5 million, which mature on January 1, 2032. The bonds were issued for 5,675,000 to yield 8%. So the effective rate here, the effective interest rate here would be 8%, resulting in bond premium of 675,000. The entity uses the interest method of amortizing premium. Interest is payable annually on December 31. Okay, very similar to problem 6-14 with the primary difference in that this problem involves a premium. The first question is what amount should be reported as premium on bonds payable? Again, just like in the previous problem, we can answer this one by first determining the initial balance of the premium. And again, it is already stated in the problem. The initial balance of our bond premium would be 675,000. The question is, how much would it be after 1 year? Okay, it will be decreased by whatever is the amortization on the said premium. If you will again look at the choices, none of the choices is greater than 675 because again, your premium and your discount are supposed to decrease uh, as time passes by. Okay, so what we need here is to determine the amount of the amortization and the premium so that we will know how much would be the remaining balance of the premium, how much would be the unamortized balance of the bond premium. Okay, and to do that, we have to compare the agreed interest payment and the interest expense. How much is the periodic interest payment here as stated in the bond? It would be 500,000. How did we get 500,000? The face value of 5 million and then multiplied by the stated or the nominal or the coupon rate of 10%. You would get 500,000. What's the second thing we need? We need the interest expense. And using the effective interest method, how do we arrive at the interest expense for the year? You simply multiply the previous carrying amount with the effective rate. How much is the initial carrying amount of the bond? Since we are dealing with the first year, we will be using the initial carrying amount. The initial carrying amount is 5,675,000 multiplied with uh, multiplied with 8%. 5,675 times 8%. That would be uh, 454,000. So again, that would be your interest expense. In case you are asked how much is the interest expense, it's 454,000, and then you compare that one with your uh, periodic interest payment of 500,000. Uh, you have a difference of 46,000. Okay, and the 46,000 there is the amortization on the premium. And since this is a premium, this would be a reduction to your uh, this would have been a reduction to your interest payment to arrive at your interest expense. But that will not be relevant anymore because we are already able to directly solve for the interest expense, which was simply 5,675,000 times 8% or 454,000. What we know now is that the amortization on the premium should be uh, 46,000. And once you have the 46,000, you just have to deduct it with the previous balance of the premium, which is in this case 675,000. So 675,000 minus 46 amortization of the premium, 675 minus 46, you will have 629,000. And that is already the balance or the remaining balance of the premium on December 31, 2022. That would be the unamortized uh, premium on the bonds as of December 31, 2022. Now, the second question is what is the carrying amount of the bonds payable? Again, the carrying amount is simply the face value minus the unamortized discount or plus the unamortized premium. So here the face value is 5 million, and as determined earlier, the unamortized or the remaining premium is 629,000. That is why the carrying amount of the bonds payable on December 31, 2022 would be 5,629,000. Okay, and if you notice that is already lower than the initial carrying amount of 5,675, because again, the carrying amount will slowly go down to, if it's on a premium, the carrying amount will slowly move down towards its face value. If it was a discount, it will slowly go up towards its face value. Okay, so four possible questions that can be asked here. How much is the interest expense? Again, the answer is 454,000. How much is the amortization of the premium? It is 46,000. How much is the unamortized premium after 1 year? It's 629,000. Fourth question, how much is the carrying amount after 1 year? It's 5,629,000. And again, as mentioned earlier, those four questions can be asked also for 2023, 2024, and so on and so forth. Now let's go back to uh, 6-11. On January 1, 2022, Marsh Company issued 10% bonds payable with face amount of 6 million. This first sentence can help us determine the periodic interest payment. The bonds mature on January 1, 2032. The bonds were issued for 5,316,000 to yield 12%, resulting in bond discount of 684,000. Okay, so the initial discount is already given. The effective interest method is used. Uh, interest now is paid semi-annually. So the process would be the same. It's just that we will have to repeat the same process multiple times a year because interest payments now are semi-annual. That means amortization will happen twice a year. Okay, you will have to amortize the discount every interest payment date because again, the amortization of the discount of the premium are supposedly adjustments to your interest payments. Okay, the amortization of the discount uh, will represent additional interest expense on your part. The amortization of the premium would be treated as a reduction to your interest expense. For the 6 months ended June 30, 2022, what amount should be reported as bond interest expense? Okay, it is semi-annual here, but the good thing is the question is only asking for the balance or the amount as of June 30, as of, after uh, only after one interest payment period. Okay, it would have been very tiresome if it was after 2 years, because that means we will have to amortize uh, 4 times. Okay, so we will be amortizing once only here. But what is being highlighted here is the difference when the amortization is semi-annual or uh, semi-annual or annual. Okay, so if this was an annual class, if the question is interest expense, as mentioned earlier, all we have to do would have been to multiply the previous carrying amount with the effective interest rate here. How much is the previous carrying amount? It's 5,316,000. That's the initial carrying amount. All you have to do is to multiply the 5,316,000 with 12%, and that would already be your uh, interest expense. But you have to take note that the question is only asking after 6 months lang. How much would be your interest expense on June 30, the first interest payment period. Okay, so you can still use the same flow class, 5,316,000 times 12%. That is 5,316 times 12%. Okay, but you'll have to understand that the 637,920 that you would get from that is good for 12 months. Okay, so you will have to divide that by 2 to get the equivalent for 6 months. Okay, alternatively, you can just multiply 5,316,000 with 6%. Where did we get 6%? That's one half of your annual effective rate of 12%. Okay, and you would get 318,960. Okay, that would already be your interest expense. Okay, but expound let's expand the problem. What if you are asked how much is the amortization? How much is the amortization and the uh, discount by June 30, 2022? Again, you just compare the 318,960 with the fixed interest payment. How much is the fixed interest payment? You base it with the 6 million, you multiply it with the stated rate of 10%. 6 million would give you 10%. 6 million multiplied by 10% will give you 600,000. Okay, but again, you have to be careful because 6 million times 10% is the annual already. Okay, so to get the correct amortization, since our interest expense is only for 6 month period, the related interest payment should also be for a 6 month period also. So either you get 10% of 6 million, then divide it by 2, or simply multiply 5%, which is one half of the annual stated rate of 10%, multiply it with 6 million. So 6 million times 5%, you would get 300,000. Okay. So uh, the fixed interest payment every 6 months is 300,000. The interest expense for the first 6 month period is 380,960. That means the amortization of the discount would be 18,960. Okay. So first question, how much is the interest expense? 318,960. Second question, how much is the how much is the amortization of the discount after 6 months? It would be 18,960. Third question, how much would be the balance of the bond discount on June 30, 2022. So all you have to do is to deduct the 18,960 from 684. So that would be 684,000 minus 18,960. That would give you 665,040. And if you, so fourth possible question, how much is the carrying amount? How much is the carrying amount on June? How much is the carrying amount of the bonds payable on June 30, 2022? Again, remember, it is simply the face value minus the unamortized discount or plus the unamortized premium. So here you have 6 million minus the unamortized discount of 665,000. You would get 5,334,000 and 960. Okay, so perhaps we will include problem 6-11 on our exam, and those four questions would be asked. And possibly we will expand this to December 31, 2022. So you will now have two amortization periods. Okay. And now, proceeding to problem 6-12, July 1, 2022, Tara Company issued 4 million 8% bonds payable with 1,000 face amount for 3,504,000. The bonds were issued to yield 10%. The bonds mature on July 1, 2031. Interest is payable semi-annually on January 1 and July 1. What amount of discount on bonds payable should be amortized for the 6 months ended December 31, 2022? Okay. So the question now here is the amount of the amortization. You're not asked for the interest expense. You're not asked for the unamortized discount. You're asked for the amount of the amortization. And what do you need here? You need to compare the fixed interest payment with the interest expense. Okay. So you cannot answer problem 6-12 without first solving for interest expense. And how do we solve for interest expense? Again, the previous carrying amount multiplied with the effective interest rate. What is the effective interest rate here? It's 10%. Okay. To what amount do you multiply the 10%? In this problem, you multiply it with 3,504,000. But again, you will have to be careful because the 10% here is an annual rate, and our interest is to be paid semi-annually. Okay, so either multiply 10% with 3,504,000 and divide it by 2, or simply multiply 3,504,000 with 5%. And you would get 3,504,000 times 5%, you would get 175,200. Now, to what amount do you compare the 175,200? You multiply it with the fixed interest payment. How much is the fixed interest payment? Again, it will be based on the face value and the stated rate. How much is the face value? It's 4 million. How much is the stated rate? 8%. But again, you will have to be careful because if you immediately multiply 4 million at 8%, you will get 320, and you might be comparing 320 with 175. But the difference that you would get there would be wrong because the 320,000 is good for 1 year. Again, this is only for a 6-month period. Okay, so either multiply 8% with 4 million divided by 2, or uh, simply multiply 4 million by 4%, which is one half of 8%. Okay, so 4 million times 4% will give us 160,000. And it is that 160,000 which we will compare with the interest expense of 175,200. We will get a difference of 15,200. Okay, so first question, how much is the interest expense? 175,200. Second question, how much is the amortization of the discount? It would be 15,200. Third question, how much is the unamortized discount after 6 months? Again, simply deduct the amortization. How much was the amortization? 15,200. How much was the initial balance of the discount? Okay, it's not directly given but can easily be computed. The face value is 4 million. It was issued at 3,504,000. That means we have an initial discount of 400. 96,000. Okay, so 496,000 minus 15,200. The remaining or the unamortized premium as of December 31, 2022 would be 480,800. Okay, and fourth possible question, how much is the carrying amount on December 31, 2022? Again, simply deduct the remaining or the unamortized discount from the face value. Pilay, how much is the face value? 4 million. Deduct the unamortized discount or the remaining discount of 480,800, you would get 3,519,200. Okay. Alternative solution to 3,519,200 is to add the amortization to the previous carrying amount. How much was the previous carrying amount? 3,504,000. How much was the amortization for this current period? 15,200. Okay, you would also get 3,519,200. Okay, please take note of the alternative solutions. Problem 6-13, on January 1, 2022, Sun Company issued 10% bond payable with face amount of 4,500,000. The bonds mature on January 1, 2032. The bonds were issued for 3,987,000 to yield 12%, resulting in a discount of 513,000. The entity used the effective interest method. Interest is payable semi-annually. For the 6 months ended June 30, 2022, what amount should be reported as bond interest expense? So here, very straightforward question. If the question is interest expense, simply multiply with the previous carrying amount with the effective interest rate. Okay, since this is the first interest payment period, our previous carrying amount would simply be the initial carrying amount. And the initial carrying amount in this problem is 3,987,000. And you multiply it with the effective interest rate, which is in this case the 12% yield rate. So you multiply 3,987,200 with not 12% because the 12% is annual and this is only for a semi-annual period. You multiply it with 6%. Okay, but I hope you understand that, of course, you can multiply it with 12%, but you just divide it by 2 afterwards. Okay, and your answer would already be 239,220. Okay, now what's the second possible question here? How much is the amortization of the discount for this period? Again, we already have the interest expense. All you have to do is to compare it with the fixed periodic interest payment. How much is the fixed periodic interest payment? Multiply the face amount of 4,500,000 with the applicable stated rate. The annual stated rate is 10%, but again, this is for a semi-annual period. We will be using 5% instead, which is one half of the annual rate of 10%. So you would get 225,000. Now, what do? You compare the 225,000 fixed interest payment with the interest expense for the first period of 239,200. You would get a difference of 14,220. Okay. So if you're asked how much is the amortization of the discount, it would be 14,220. Third possible question, how much is the balance of the discount after the first 6 months? How much is the unamortized discount? Again, you just deduct the amortization from the previous balance. How much is the previous balance of the discount? It's 513. Deduct 14,220, you would get 498,780. And fourth possible question, how much is the carrying amount? Again, that is simply the face amount of 4,500,000 minus the remaining or the unamortized discount of 498,780. And what is our alternative solution? The previous carrying amount of 3,987,000 plus the amortization. How much was the amortization of the discount for the first 6 months? It's 14,220. And you would still get 4,001,220. Okay. We'll stop here for a while, then additional discussions for the other problems will be given afterwards.